an administrative note. So feel free to use the chat functionality on the webcast to submit some questions and answers, or submit some questions. We will be getting to those at the end. Our moderator will be asking us those questions, so feel free to submit those as we go along. And with that said, we will get into why humans make bad investors. So first, just a bit of background on us. So I am Doug Walters, the Chief Investment Officer here at Strategic Financial Services.
Hello, I'm Aaron Evans. I'm a Senior Advisor at Strategic Financial Services.
All right, thank you, Aaron. So we're going to spend about the next 45 minutes or so talking about a field of study that's called behavioral finance. So the human brain has evolved over millions of years to help us adapt, survive, and then ultimately flourish on this planet. What behavioral finance shows is that although evolution has served us well in many ways, it hasn't always served us well in the realm of investing. So we're going to delve into that. So our agenda today, first, we're going to talk about why we as humans are bad investors, and I'll go through some interactive examples. We'll have a bit of fun doing it, talk about some psychological studies, and then Aaron's going to dive into what we can do about that. So how do we avoid these potential behavioral pitfalls that could trip us up as investors? So let's get right into that. So there's a number of behavioral issues that we face as investors. Some of those are just pure mental errors, right? As humans, we're not perfect. We make mistakes. In other cases, there's sort of real behavioral biases that have been ingrained in us over years of evolution. We're going to touch on a few of those, and again, give you some real concrete examples as to why these can trip us up in terms of investing. And we're going to do that through 3 exhibits. And so let's get right into the first exhibit, which is a coin flipping study. Okay, so this guy named Shiv did a coin flipping study. And what he did is he had participants get $20, and he did 20 rounds of coin flipping. Okay, in each round they had a choice. You either invest $1 or you don't invest at all. Very simple. The coin is flipped. If it's heads, any money invested is lost. If it's tails, the money invested is returned plus another $1.50. So you're making out if it's tails. So what made this experiment interesting is that there were actually 3 types of participants that were studied. So we had what we'll call our no brain damage category. So, individuals who had suffered no brain damage, just your average person off the street. There was a second category, those that actually had incurred some sort of brain damage but were still able to feel emotion. And then a third category, a very specialized category, are those that had some brain damage and actually had impeded their ability to feel emotion. So what we're going to do is go shut off the presentation, go live here with Aaron, and we're going to perform this experiment with Aaron. So I have a stack of $21 bills I'm going to give Aaron. And what I'm going to do is ask him if he wants to invest, flip a coin, and see what happens. You ready, Aaron?
Let's do it. I'm in for the first round.
All right. He's investing in the first round. I'm flipping the coin. It's tails, so Aaron wins.
All right.
I give Aaron $1.50. Just like that, he's up $1.50. Now he's got a choice. Are you going to invest again in round 2?
I'm on a hot streak. I'm going to keep going.
All right. Aaron's in for round 2. Coin flipped. It's tails again. All right. He'll give you 2. He'll give me 50 back. Aaron's up $3 just like that. All right. Round 3. Are you in, Aaron?
I'm on fire. Absolutely. I'm going in.
All right. Aaron's in. We're flipping. And I'm sorry, Aaron, but it's heads. So you've lost your $1.
Ooh, okay.
All right. Are you in for round 4?
I'm in one more time.
All right, Aaron's in for round 4. We're flipping. And I'm afraid it is heads, Aaron. You've lost that dollar again. Round 5, are you in?
I think I'm done, actually.
All right.
I've lost too many times.
So let's freeze it there. Get the presentation back on and think about what happened here. So Aaron was on a hot streak, lost a couple of times, and eventually pulled out from investing. So let's take a look at what Shiv found when he did his study. And let's first look at, well, we'll assume Aaron is in the no brain damage category. Let's first look at that no brain damage category. What we found is, you looked at what was their likelihood of investing after an event the previous round. So, for example, if they did not invest in the previous round, how likely were they to invest in the next round? About 65%. If they invested and lost, they only invested about 40% in the next round, 40% of the time. And if they invested in one, they were likely to invest about 75% of the time in that next round. Let's look at our second category. We've got brain damage, but can feel emotion, and it looks almost identical to Aaron's category. And then the third category, that special type of brain damage that doesn't allow you to feel emotion. What we see here is something very different, a much more consistent pattern of investing. In fact, overall, those individuals invested about 80% of the time, a bit over 80% of the time. And what's really striking, that when they lost in the previous round, it really had no impact on their willingness to invest in the next round. So let's put that aside for a second, dig a bit deeper into these numbers. And what Shiv did is he looked at how this relationship played out over time. So we have here our first 5 flips, second 5, third, and then the fourth flips. And what we see in Aaron's category, with no brain damage, over time, the propensity to invest gradually declined. So they became less and less likely to invest as the game went on. Brain damage with emotion, fairly similar trend. And not surprisingly now, brain damage with no emotion, a very consistent propensity to invest throughout the experiment. So, what's going on here? What's going on here is what Shiv describes as risk aversion, or also known sometimes as prospect theory. We as humans tend to get emotional and short-sighted in our decisions when we're faced with potential losses. Okay? And the longer we find ourselves in this position, the more pronounced this effect can be. And so you can see how this can impact us in the investing world. So in the investing world, this is really most evident in bear markets, right? And the worse the bear market, the longer it goes on, the more severe the impact. So bear market comes. Let's take the extreme example of the financial crisis. Stocks start falling, investors start pulling out. Stocks fall further, they pull out further. As the stock market goes down, investors are getting less and less invested in this asset class. The problem is that's the exact opposite reaction we should have in a sell-off. So let's take a look at that pictorially. So this is how we think about bear markets, right? This is what behavior has taught us to do. It's taught us to be scared in the face of losses. How should we be thinking about bear markets? It's the market on sale, right? When you think about it, you know, as humans, we typically flock to sales. Think about Black Friday, you know, early morning outside of a Walmart, you know, we are flocking to those sales. We should think the same way when it comes to the stock market. When the market sells off, if you're a long-term investor, you should be out there bargain hunting, all right? So fight evolution, fight risk aversion, get out there and get investing. So that's our exhibit number 1. So on to exhibit number 2, which starts off with an example. We'll study on cars, driving to be more specific. So this guy named Svensson went out to Americans and asked them a very simple question. Are you an above average driver? And what he found was 93% of us think that we are above average drivers. Interesting. Not sure how that math works, but clearly something going on there. In the investing world, we see the same thing. So another study looked at investment analysts, so professional investment analysts. And when they were 80% certain a stock was going up, on average, they were only right about 40% of the time. So the question is, what's going on here? And what's going on here is something known as overconfidence. So what does that have to do in the investing world? How does that impact us? Well, as it turns out, what we find is that overconfidence and our own abilities can lead to excessive trading. So trading, overturning your portfolio. Now, so let's take a look at a bit more detail. Overconfidence, excessive trading. So what a number of studies have found is that men are more prone to this overconfidence than women. And then that plays out into excessive trading. So the numbers actually show men trade 45% more than women on average, and single men, sorry guys, you're trading about 67% more than single women. So is this a problem? Well, actually it is. So another study shows us that the more excessive your trading, the lower your investment returns. So this study in particular looked at households, and it broke them up into below average, average, and high trading volume, and found out that for the household with sort of average trading during this time period, the return was 16.4% on their investments. For those that exhibited high trading, excessive trading, their returns were only 11.4%. This is a huge difference, right? So over time, just put this into numbers, so a $10,000 investment over 30 years with these different returns results in a very different final balance. So to summarize this, we've got overconfidence, which is sort of ingrained in us as humans. This leads to excessive trading. Excessive trading leads to lower returns. Lower returns leads to, we'll say, less happy retirement. So that's exhibit number 2. Now, exhibit number 3. Let's get Aaron's winnings out of the way. And what we're going to do here is look at a little wine experiment that was done. And it was done by a guy named Plasman. So what Plasman did is he presented participants with a glass of wine to rate. We asked them to rate it on a scale of 1 to 5. And in this study, there were 5 different wines that were used. So one was $5, one was $10, one was $35, $45, and the other was $90. So if you don't mind, Aaron, how about we sort of play out what this experiment may have looked like?
Sounds good.
All right, so let's get this presentation out of the way. And we just happen to have 5 bottles of wine hiding underneath the table. And just like in the study, we have our $5 wine, we've got a $10 wine, 35, 45, and then our $90 bottle of wine. So Aaron, I'm going to start you off with the $10 bottle of wine.
All right.
So
I like this webinar.
yeah, just a little taste test. Okay?
All right.
So there's your $10 bottle of wine.
Smells cheap. One to five, I'll give it about a 2.
All right. So Aaron's giving our $10 bottle of wine a rating of 2. So then we'll jump right up to the $90 bottle of wine. See what he thinks of this one. There you go.
Very aromatic. Tasty. I'll give that one about a 4.5.
Okay. So Aaron's rated our wines. He's rated the $90 wine higher, $10 wine lower. So let's take a look at what Plasman did in this. So as is often the case in these psychological studies, Plasman was a tricky guy, okay? So it turns out, if we take the $10 bottle of wine and the $90 bottle of wine, in his study, they were actually both $90 bottles of wine.
Whoa.
And more than that, in fact, the $45 bottle of wine and the $5 bottle of wine were both only $5. The $35 bottle actually was $35. Okay. So what's going on here? So there's actually only 3 different types of wine, even though we had 5 different prices. So let's take a look at what Plasman found. All right, with our wine bottles out of the way, the result, just like we saw with Aaron, the higher the price, the higher the perceived rating. The lower the price, the lower the perceived rating. The actual statistics look like this. So the one, let's take Aaron's wines. The $10 wine here was rated at 2.5 on average, so you were pretty close to average. And then the $90 bottle of wine was ranked all the way up as a 4. And as we know now, those were both $90 bottles of wine. Likewise with the $5 and $45, you saw a similar relationship, even though underneath they were really just the $5 bottle of wine. So what's going on here? What behavioral finance tells us is this is something called anchoring. Turns out our brain's very efficient, right? It uses anchoring to simplify its decision making. In other words, it's using the information, all the information it has available to it to help make a decision. So in this case, we had a price. That's information. Aaron's brain was acknowledging that information, and he went into this study with the assumption that $90 bottle must be better. So what we find in the real world is sometimes this works well for us. Again, often some better decision making. Sometimes it works against us. And it works against us in a way we see, almost every day in some way, shape, or form, which is in the form of sales. So let's take the example of, say, a leather jacket. So you go into a store, pretty high ticket item, leather jacket, and you see a price tag of $1,000. You were thinking maybe you had $500 to spend, $1,000 way too much. So thumbs down, you're not buying this jacket. However, before you can get out the door, the salesman is over to you and says, "Oh, I saw you're interested in that jacket. Did you know it's actually only $600? It's on sale." Suddenly that thumbs down becomes a thumbs up, and you're walking out of that store with a brand new leather jacket. So what happened here? Again, anchoring. Your brain anchored the value of that jacket at $1,000. When you see a new price tag of $600, this looks like value to you, even though the reality is this jacket was probably never worth more than $600. So let's take another example of anchoring, and now let's put this into sort of real investment terms. So oftentimes in the investing world, what we find is people more than willing to accept high valuations because we've anchored ourselves to those levels. And this was never more evident than in the tech bubble. And the one thing that struck me about the tech bubble, as well as many others, is just how creative analysts became when they valued these companies. So you have tech companies with enormous valuations, no profits, and analysts start talking about things like customers per click, eyeballs, time per visit, price to sales. I mean, what happened to profit, right? Profitability, profit margin, out the door. Because we had anchored values at these high levels, analysts found a way to justify them, okay? They fell into the trap of anchoring. And one last example we have for anchoring is a study that this guy Statman did. So he took Fortune magazine's rankings of the most admired and despised companies based on their long-term investment value. So Fortune does this every year. He compiled up this data historically. What did he find? So he found, so the admired companies had these wonderful historic traits, right? 10% sales growth, 12% earnings growth, high return on investment, high 3-year stock price move, and despised companies were much lower. What we also found is valuation, as a result of this, was much higher. We'd sort of anchored ourselves on these high valuations based on these historical numbers we'd seen. Well, what Statman showed is, unfortunately, did not translate into stock performance. So these admired companies, 2 years on, 3 years on, and 4 years on, underperformed the despised companies. So despite their good historical traits, they didn't end up being good investments for their investors going forward. Again, we'd anchored ourselves on the view these stocks were should be admired, should be invested in, should be deserve a premium, and it just didn't prove to be the case. So we've talked about risk aversion, talked about overconfidence, excessive trading. We've talked about anchoring. So we have a good sense of the challenges we face as investors. So now, if we're wired as humans to be such bad investors, what can we do with that? And with that, I'm going to hand it over to Aaron.
All right. Well, first off, I'm just glad I was placed in the no brain damage category. Thank you for that. And I got to have a little wine along the way. So a very exciting webinar so far. So Doug gave us all these examples of how we as humans feel these emotions and let them affect the way we invest. And what we're going to talk about is some things that you can do to be a little less human and hopefully a little bit better investor. And really the key aspect of all of these is to make sure we're not thinking in the short term as investing as sort of this get-rich-quick scheme, but really taking a long-term focus and helping us protect and grow capital over the long term. That will help take some of the emotion out of things that are very short-term, and emotions happen to be very short-term. So we're going to talk about sort of forced savings and investment, a concept called market timing and avoiding that, how to filter out the noise, and we'll talk about what that is, the importance of diversification, and lastly, just being conscious about the various types of fees that are out there in this crazy investment world. Okay, so the first step you can do is sort of force yourself to save and invest and get the capital into a saving or investment vehicle before you do something else with it. This is just kind of that concept of before you can be risk averse, if you could just get that capital into the place where you want it to go, you can avoid doing something else with it, whether it's just sitting on it or spending it on something that you don't need. This avoids an additional bias that's known as self-control bias, which we all exhibit, where you have a short-term need and you satisfy that short-term need, but in that short-term need, you sacrifice what could be long-term satisfaction. So we do it all the time. I'll give an example. It always happens when you're eating. I'll just have the extra slice of pizza now and worry about it later. Again, you just need to make sure you're always thinking about the long-term. Same thing with your investing. So what are you going to do to get that capital out of your own hands and make sure you kind of force yourself to get it invested? One of the first places you can do is just get a separate savings account and make sure that capital is being funneled into that savings account before you have it in your checking. So if it's in your checking account or available for you to spend, you're probably going to find a way to spend it if you're like any of us. So if you can get it out of the way and make sure it gets into that safety account, you'll know it's there and get it out of the way. Another great place to do this is in your corporate retirement plans. So this comes out before it even hits your paycheck and goes into your checking account or before it comes to you. So what you can do is make sure you're participating in these plans, getting it out of your own hands. And really, this is the only other example where there is a such thing as a free lunch in the form of matching contributions from your employer. So make sure you're taking advantage of those if they are available to you. Next, there are some tax-advantaged accounts that are available to certain investor types. They provide long-term deferred tax vehicles for retirement savings or possibly for education savings. So take a look at these. Make sure you partner with your accountant or your advisor to make sure that you're eligible. There are some very stringent requirements for each of these. And then lastly, if you have all of those done and you have some additional capital, figure out a way to kind of get that out of your hands and into the investment account. So we talk about risk aversion, overconfidence, and anchoring. We're going to talk a little bit next on how you can do that, but get it out of your own hands and into an investment account. The next thing we're going to do to sort of avoid some of these emotions is avoid a concept called market timing. And this really plays to that overconfidence study that Doug highlighted earlier, where we think we know best. And in fact, if we were very perfect investors and we were all robots, then it would be a very simple game, and a lot of us wouldn't be in business, and we would all buy at the extreme lows and all sell at the extreme highs, and it would be a very simple thing to do. But what we've actually shown is that in this study we're going to review next, it's actually a very difficult thing to do to time the market. During this study, we're looking at 20 years of data between 1995 and 2005. And we said, what would happen if during that 20-year period you missed only the 10 best days of trading, just the 10 best days? So you're out of the market potentially for 3 or 4 of those 10, or maybe all 10. If you missed all 10 of those, the return on your investments over that 20-year period, the annualized return went from 9.85% down to 6.1. So you just lost over 3% annualized over 20 years just by missing those 10 best days. And you can see what happens if you miss the 20 best days, the 30 best days, 40, 50, and so on. Your investment, if you had just remained invested, it goes from $65,000 and drastically gets reduced just by missing some of those days. So this concept of market timing, it's very difficult. You have to know exactly when to get in, when to get out, and you've got to be right more often in a lot of different ways. So a very difficult task to do. The other thing you can do to avoid this concept of trying to time the market is make systematic investments. Make systematic investments over time and be sort of oblivious to what the timing of the market is. Okay, so you don't want to take into account where the market is at that current time. And one of the benefits of that investment approach is something called dollar cost averaging. In this first example, you see we have a stock that trades, and it started out at $10, and over time it hit a couple different prices, a little volatility, and ended up right back at $10. One approach to investing in this stock would have been to put $8,000 in right at the outset. So I bought $8,000 worth of the stock at $10 a share. My average cost per share was $10, and then at the end, everything was worth $10 again, and I returned nothing. So I went straight from the start to the finish, didn't make any earnings. Another approach would be to make monthly investments of $1,000 each month, over 8 months. And you can see what happens is I purchased the stock at various price levels throughout time, and my average cost was actually reduced to $9.61, and I actually experienced a positive return of 4.07% by using this systematic approach of automatic investing. Okay, so one benefit of doing that systematic approach, dollar cost averaging, you can actually reduce your underlying cost of the investment. Another benefit of sort of systematic investing throughout time is a concept called compound returns. A lot of us are familiar with this concept, but it's worth highlighting in an example here to just see what is really the benefit of investing long-term and how compound returns can impact your portfolio. So if you started today, you can see that the compound returns start to drastically increase your portfolio, and it is exponential growth. It is not linear growth. So you can see this curve here starts to grow more rapidly and rapidly, and the more money I have, 10% of more money is more money, and we start to grow quite rapidly. If you delay 5 years and you don't start, you can see, again, now you have to play catch up. So just by missing 5 years, you're already behind the curve, and then the same thing goes if you wait for 10 years. So start now, systematically invest, don't worry about market timing, and you're going to be on this path, hopefully, to long-term compounded returns and growing your portfolio. Okay. Another common emotion we have is this risk aversion or fear that is driven into us when we see things that we don't like or we're faced with a loss, or in this case, we're talking about the media and the news. And we're trying to filter out all this noise. And if anyone's watching the media these days, it's filled with quite a bit of noise, not all about finance. There's an election coming up, so there's a lot of things to keep out there, and there's a lot of noise. And you can see some of these highlights, headlines that we've given examples for here. S&P hits all-time high. The Dow Jones average falls 200 points. Oil's at an all-time low. GE earnings are falling. Sometimes there'll be something so random as this is the worst Tuesday in September since 2013. It doesn't really matter. So they tend to be very short-term focused, very fear-focused, and tend to make us as investors a little more risk-averse when we see these things. So we try to filter this out. Okay, so it feeds that risk aversion. So one example of this, as we look at where we are in the markets more recently, is the market is at an all-time high. And when we hear that, we start to say, well, I probably need to get out. We're at an all-time high.
It certainly looks high to me, yeah.
It looks very high. It can't go any higher. I might want to get out. And when you look at it on a linear scale here, it does look like, yeah, this is a sort of a very high peak here relative to some of the places we've been in history, especially when you look over the history of the stock market. So you might get panicked by hearing that. But we want to point out, should we be concerned? That's the question we're answering. What we want to point out is that if you plot this, again, we're talking about compound returns, so we want to plot it on a linear scale to sort of see what happens. And if you look at this black line, this is sort of the normal trend of the market throughout this period. And you can see that the good thing is the stock market tends to go up over time. And that while there are some peaks and troughs, just because we're at all-time highs does not necessarily mean that we are at a wild variation from this normal trend of where the market should be. So currently we're here. And if we look at a couple past events, we can see that, there's our little graphic coming up. This is where we are today, but it's not 2000. If you look at where we were in 2000, we are 2 standard deviations away from that normal progression of the stock market. So that's a point where maybe we should be concerned. Yes, we're at all-time highs there as well, but we're varied wildly from sort of the standard path of the market. And again, during the financial crisis in just pre-2008, 1 standard deviation away from that normal path of the market. And again, the other thing to point out is just because we're at all-time highs, if you look at the market, it sets all-time highs just about every few years, if not every year. So we should always be setting all-time highs, and it's not a bad place to be.
Right. Sign of a healthy market.
Sign of a healthy market. All right, so don't panic about the noise. That's just one example. Obviously, there are a lot of things, very short-term focused. Sort of keep your mind in that long-term path and try to filter it out as best as possible. The next thing we can do as investors is to diversify, and this is an important concept to avoid some of those biases that we see. It avoids a little bit of overconfidence. I know exactly which stock to buy. I know exactly which fund to buy. It avoids risk aversion by reducing volatility. So if we're riding this roller coaster of wins and losses, we're going to be very emotional about that. So if we can smooth that down, it might tamper our reactions a little bit to those swings. And then the other thing we'll talk about is we'll give an example of diversification here. So this is a great chart. This chart shows the returns of some of the most popular asset classes, large cap stocks, small cap stocks, bonds, and cash throughout a 20-year period from 1995 through 2014. And it's nice and color-coded. So what you can see is each year we rank the asset classes from best performing to worst performing. And we have a nice little graphic here that shows if you follow the small cap, this dark blue color, throughout time, it goes from sort of an average asset class to being one of the best, down to being middle, down to being the worst, back to being the best, one of the worst, and then back to sort of in the middle. So a little bit more volatility throughout time. And again, if you're an emotional investor, riding that roller coaster might trigger you to do things, which could be avoid that bear market, as we gave the example before, and panic and sell when it's down here, one of these lower returns, or potentially be overconfident about something that's in one of those higher returns. And the next example we're going to highlight is this white square, which is a diversified portfolio. And what we show is that if you follow the track of this diversified portfolio, again, a much smoother ride throughout time, throughout this 20-year period, where it's hovering right around the middle of the road in terms of performance. And in the end, you're getting good returns over the long term without experiencing that volatility. So that's going to take a lot of the emotion out of that 20-year period, and hopefully it may avoid some of those pitfalls that we make as investors. The other thing diversification it does is it helps us rebalance portfolios. So what we want to talk about is making sure that we don't just keep things in the status quo, and that we have a nice diversified portfolio that is rebalanced from time to time, and we don't just keep things as is all the time. Another bias that we employ. Okay. Here's a more concrete example of how diversification benefits investment returns, and this is the most memorable negative performance period in the market for most people, the financial crisis 2008-9. What you can see here is in the first column, if we look at sort of the first leg of this period, the negative return period, we see three portfolios: an all-cash portfolio, a diversified portfolio between stocks and bonds, and an all-stock portfolio, sort of the most risky portfolio. And as expected, cash earned a little bit of interest. It didn't go down. It wasn't invested in the stock market. A diversified portfolio was down about 35%, and the all-stock portfolio was actually down just about 50% from peak to trough during this period. So a lot of volatility there, little volatility here. What happened in the next 5 years, sort of from the bottom of the market going up until February of 2014? Well, cash stayed flat as expected. The diversified portfolio was up 100%, and the all-stock portfolio was up 162%, which looks intriguing, but you had to go through this down 50% period just to get back to here. And how does it look when we put them all together? Cash 2%, and what you can see here is the diversified portfolio is just shy of the all-stock portfolio by about 2% during that period, but with much less volatility. So we didn't have the painful swing of being down 50%. We were down some. We weren't immune to being down. We weren't having that high roller coaster of seeing ourselves up 162%, and we got to about the same endpoint. So again, smoothing the volatility over time, and an example here of one of the financial crises that's really fresh in a lot of our memories. Okay? And the last thing we're going to talk about in terms of avoiding some of these emotional aspects of investing is being smart about fees. And as Doug mentioned, a couple things: we can make mental errors where we don't understand exactly some of the things that are going on with our investments. We also tend to just take simplification of data and just assume, my fees are probably reasonable, and I'll just assume they're okay. So what we want people to do as investors is just be cognizant about fees and understand a little bit more about them. So the first thing to understand is that fees come in several different forms in the investment world. The first that most people are familiar with is a management fee. This is something that you would charge an advisor or an investment manager for the services they offer, and it's usually charged as a % of the assets that you have invested with them. The next is commissions, and we've all seen commissions. Commissions are in a lot of industries, not just this industry, but this is a fee that someone gets for selling you a particular product. So an upfront fee just for making a sale. Trading fees. So as Doug talked about, overconfidence can lead to overtrading, and there are fees associated with that trading potentially. So you just want to make sure you understand what is the impact of that. So those returns for those couples in the households that overtraded were lower. Part of that is because they experience excess trading fees. Correct. And then lastly, one that not everybody is as familiar with are this concept of expense ratios, and particularly this comes into play when you have a mutual fund or an exchange-traded fund. And there are expenses associated with having another manager from an asset management firm manage a portion of your portfolio. And it's not directly seen on your investment statements, but it is something you can research and ask, and you want to see how those, what are those expenses in the investments that you have. Okay, so for some, it can be very close to zero, very low for some passive index funds, lower for some passive exchange-traded funds, but it can be certainly high in some investments, as high as 1% and even 2% or more. So something to be cognizant of. What else can you do as an investor relative to fees? Well, one thing you can do is ask questions. Again, most people tend to just kind of accept the fact that their fees are probably in line with where they should be, but you can certainly ask. That's one thing you can do to be a little bit better investor. one thing to ask, how is my fee structure set up? What types of those fees that we just outlined are you paying? Are you paying trading fees? Are there commissions for some of the things you're paying? Are there additional expense ratios in the investments that I'm buying? So just ask those questions, and then think about, is that fee structure aligned with my goals? Again, if my fees go up as my portfolio grows, that seems to make sense. But if I'm just paying commissions and excess fees along the way, I want to make sure that my advisor is incentivized to grow my portfolio and not just generate additional fees. Again, those hidden fees. What are those fees that I don't see on my statement? Ask that question, and it's certainly available out there on the internet as well if you want to do a little research. And those trading fees, again, that could encourage excess churning of the portfolio, excess trading, which, as we've shown, can definitely impact your returns over the long term. And then lastly, are the advisor fees worth it? And that's a question that we get all the time, obviously, and one that we like to discuss at length. And here's a study that Vanguard did, and it's particularly of interest as we talk about this concept of behavioral finance. So Vanguard, who is one of the leaders in the low fee camp in the investment world, did a study of what is the value added in a percentage term of some of the services that an advisor provides. And I'm not going to go into each one of these, but I will go down and highlight one. And you can see here that this concept of behavioral coaching, according to Vanguard, is the most valuable thing that an advisor can do for you over time. So again, you can, as an investor, try to avoid some of these emotions yourself, but partnering with an advisor along the way definitely helps you stay the course, manage some of these situations that come up, and manage these emotions throughout time in the market. Having someone to talk to, having someone to explain some of these concepts to you in more detail and navigate the noise is very valuable, over 1.5% a year. So again, a well worth study, and one of the most powerful things you can do in terms of value add of working with an advisor.
All right. Well, thank you, Aaron.
All right.
So that brings us to the end of Aaron's section, and I guess what I would like to say is, if none of this sounds very exciting, that's good. And there's a great quote we've got here from Paul Samuelson. So investing should be dull. It shouldn't be exciting. Investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas, right? So continue, focus on the long term, avoid these behavioral pitfalls, keep it boring. That's your path to long-term prosperity. So before we officially wrap up into Q&A, I just want to give you some further reading. So Value Investing by James Montier is a fantastic book on behavioral finance. It's where we got a lot of our content. You'll see some of the studies we discussed, plus you'll see some more. So if you're interested in this topic, it's a good place to learn more. And with that, we will open it up to questions. Again, Q&A entered in through the chat, and our moderator will pose those questions to us.
Okay, so our first question is, it is hard not to anchor on the recent 2008-2009 crisis. With stocks and bonds at the time highs, shouldn't I be in cash?
Right. So it's a great question, right? So 2008 was a very scary time, and it's left a scar on a lot of investors. I think what I would focus on is the chart that Aaron showed that that the long-term path of the S&P 500. And then on top of that, think about the discussion on timing. Because the risk is, if you pull out now, you may miss those 10 best trading days of the next decade.
Or even just one or two of them.
Right. So if you keep the focus on the long term, what you want to be is, have a portfolio of stocks and bonds and other asset classes, stay diversified, and have a portfolio that's well matched to your risk tolerance. And Aaron, I don't know if you want to talk a little bit about risk tolerance and how that would feed into this discussion.
That's a great question and a great discussion, and it really plays into this concept of behavioral finance. And when you put together a portfolio in a process we called asset allocation, putting together different types of stocks and bonds into a portfolio, if you just did it based on math alone, it really wouldn't jive well with behavioral finance. And what we found is we have to really think about investors and their ability and willingness to take risk and help that drive a little bit of where we allocate their capital. So this concept of being an all cash might make sense for someone who has zero ability to take risk and absolutely no willingness to take risk. That's someone that might not be able to be invested in the market. But that's where partnering with an advisor comes into play, where we can really look, okay, you have the ability to be invested for 5, 10, 20 years and take some risk in your investment portfolio. And then we have to help encourage them on the willingness side, particularly this person who asked this question about should I be in all cash, helping them understand these concepts that we just reviewed, that you will be rewarded for taking a little bit of risk over the long term. So yeah, it's very easy to anchor on those time periods where things were very bad, but you can't market time. It's very, very difficult to do. And just you have to get comfortable with the fact that as long as you have the ability and you understand your willingness to take risk in the right portfolio for you, you'll be compensated for taking the risk that you want to take over the long term.
Great. Yeah, great answer, Aaron.
Okay, great. I have another question. As investment professionals, how do you guys manage and avoid these emotional biases when you are investing for your clients?
Sure. That's another great question. It's really all about process and making sure that you have a very disciplined, repeatable process, and having that to fall back on and lean on during times that are emotional keeps you on path to keep our investors where they need to be. So it's really just about having that process in place, making sure it's disciplined, making sure it's repeatable, and making sure you use it. That's how you avoid these emotional pitfalls.
Yeah. And when we work directly with clients, obviously that comes back to that discussion of really understanding the client's risk profile, making sure we set up guidelines for them throughout time so that we understand where we should be, things that might form an investment policy statement that help provide us with guidelines to, again, navigate through those times.
Right. Well, to give a very, again, the extreme example of the financial crisis, you don't want to be halfway down that 50% decline in equities and be wondering, all right, what do I do now? Right, that's the last point. You do not want to be making sort of emotional decisions at that point. You should be answering that question now while stocks are at an all-time high. What happens if stocks fall 25%? What is our action plan? Right, disciplined, repeatable process that you can follow, that's set in place, before these crises, before these emotional situations come about.
Good.
Okay, we have another question. What kind of returns should I expect in a diversified portfolio?
That's a very good question, and it begs a little bit of a further question because diversified portfolio can mean a lot of different things. So at the highest level, when we talk about a diversified portfolio, it's going to be a mix of some form of stock investments and some form of bond investments or fixed income investments. And depending on the mix of those and the underlying types of stocks and bonds that you invest in, the investment returns can vary. Ideally, over the long term, if you're invested, whatever portion of your portfolio is invested in stocks, could get somewhere between, let's say, 6 and 8% annually over the long term, never measured in the short term, as we've just proven. And in fixed income investments, in a normal fixed income environment might be a little higher than they are today, maybe around 2 to 4%, but right now they are low because we are in a very low interest rate environment. So it is not a single number in a diversified portfolio. It very much depends on what that diversification is made up of.
Right. For some individuals, a diversified portfolio might be 30% bonds, 70% equity or equity-like instruments, whereas for another it may be a 50-50 portfolio, and those are going to have very different return characteristics.
Yeah.
Okay, great. Thank you. At this time, I don't see any more questions, but I do need to read a disclosure statement. The advice provided is general advice only. It has been prepared without taking into account your objective, financial situation, or needs. A professional advisor should be consulted before implementing any of the options presented. And with that said, to all the attendees, you will be receiving a link in the next few days that will take you to a copy of the presentation for you to have. So be on the lookout for that as well.
Okay, great. Well, thank you everyone for attending. Very much appreciated it.
If any
Thank you.
Feel free to contact us after the fact.
And their information will also be on the link that we'll send.
Perfect.
Thanks, guys.
All right, thank you.
Thank you, everyone.
Everybody have a good day.